steel and U.S. Steel in particular had a problem over the past year with cost. And also, obviously, with very poor macro fundamentals. And the gas boom is really starting to sink in now. And it's helping U.S. Steel a lot in two ways. One is their shipments of tubular goods, it's basically steel pipes, are way up. And the second is that they've managed to use the lower electricity bills in their steel mills to cut their costs in a big way. There's a projected $80 million of savings this year in lower gas bills, basically energy costs. And they're also replacing coking coal, one of the main ingredients in the steelmaking process, with gas using new technology. And that's allowed them to offset the very high prices for iron ore right now, which is obviously steel's other main ingredient.
So we're going to have a quick look at the stock chart now. It's at symbol X for US Steel, and hopefully we got that now. And apparently it's up 25% over the last month, which is quite a move. We've got one of the things we've got to know about US Steel, as all commodity companies, is that it's a very cyclical business. So you can see these major moves. Now, John, correct me if I'm wrong. The iron ore price might not be low right now, but it could fall back quite quickly if we see China go into a slowdown, right? Because they're one of the main buyers of iron ore.
That's right. And I talked to BHP Billiton last week, which is one of the world's biggest miners of iron ore. And one of their executives actually caused a little bit of a tumble in the steel market last week, a micro tumble, when he said that he thought China would grow at only 6 or 7% instead of 7 or 8%. And it is that sensitive. BHP the last week told me they're still fairly confident that China will maintain its pace and will keep on buying iron ore from Australia and keep on making similar quantities of steel. And they're projected at a billion tons of steel within 5 years.
Now U.S. Steel, how much can it use all of its production with natural gas, or does it still have to rely somewhat on coal-related products like coke?
Right. So no, coking coal remains a key ingredient. The projections by UBS last week show that U.S. Steel could save $133 million this year by replacing some coking coal with natural gas. This is also the gas boom, by the way, is helping integrated steel makers like U.S. Steel and ArcelorMittal over the so-called mini mills, which melt down scrap to make steel, like Nucor. And so U.S. Steel says that it costs them about $600 a ton to make, or $600 to make a ton of steel. And by replacing some coking coal with natural gas, they can cut that cost by $10 per ton of steel.
So John, so obviously the gas boom has been great for the steel business, but how long can it last? I mean, I don't want to be a downer, but in your story, you did say that natural gas prices have fallen so low that some energy companies are reducing investment.
There is that concern. However, I was talking to a senior analyst, Bob Adison, for IHS this morning, and he was saying that it could be compensated by drilling for oil, which is steady or increasing. And the gas play here is so strong, and you're seeing a lot of, especially petrochemical companies, looking at moving back to the United States to take advantage of the lower gas prices. And it's so strong that in the long run, there isn't a sort of structural concern that people are going to stop drilling for natural gas. It might slow down a little bit during gluts in supply, as seems to be the risk for currently. But in the long term, this seems to be a pretty stable bet.